Imagine waking up one morning, checking your portfolio, and realizing the boring, unsexy part of your investments quietly outpaced everything else. No hype, no sleepless nights, no checking charts at 2 in the morning. That's exactly what happened to me last year. And honestly, it broke my brain a little. We're not talking about some meme stock moonshot or a crypto flip that went right for once. We're talking about cold, steady, almost embarrassingly predictable dividend income beating out price gains in one of the more turbulent markets we've seen in recent memory. And before you roll your eyes and picture your grandfather clipping coupons, stick with me, because the numbers are going to surprise you. Last year, the broader market gave investors a roller coaster that felt more like a punishment than a reward, with volatility spiking, rate uncertainty dominating every headline, and growth stocks getting absolutely humbled. Meanwhile, a quiet corner of the market was just paying people every single quarter, rain or shine, like a vending machine that never runs out. The reason this happens isn't magic, it's structural, and once you see it, you can't unsee it. Companies that have committed to returning cash to shareholders have essentially signed a contract with you, and breaking that contract tanks their credibility, their stock price, and their CEO's reputation simultaneously. Think of dividend-paying stocks as the reliable coworker who always finishes their work on time, while growth stocks are the brilliant but chaotic freelancer who might deliver something genius or might ghost you entirely for 6 months. We spent years obsessing over the freelancer, and a lot of us quietly forgot the coworker was still there, building tenure, accruing benefits, and quietly compounding. The psychological shift required to appreciate dividends is genuinely underrated. We are wired for dopamine, for the thrill of a stock doubling, for the story we get to tell at dinner. Dividend investing is harder to brag about, which is probably the most ironic reason it actually works so well over time. Historically, dividends have accounted for a staggering portion of total equity returns. Some studies put it near 40% of the S&P 500's total return over the past century, and yet we treat them like a footnote. There's a reason the greatest compounding machines in investing history quietly reinvested those payouts decade after decade without anyone making a YouTube video about it. Now, the misconception I hear most often is that high dividend yields automatically signal safety, and that is dangerously wrong. A 10% yield on a crumbling company is just the market screaming that the dividend is about to get cut. What you want is a growing dividend from a company with strong free cash flow, manageable debt, and a demonstrated commitment to raising that payout year over year. My picks last year weren't flashy. We're talking about names in energy, infrastructure, healthcare, REITs, and a couple of consumer staples companies that have raised their dividends for more than 20 consecutive years. The strategy wasn't brilliance, it was discipline. I sized the positions based on yield sustainability, not yield size, and I held through the noise without flinching. The actionable lesson here is deceptively simple. Build a basket of dividend growers, reinvest automatically, and treat volatility as your friend rather than your enemy, because lower prices just mean you're buying more yield for the same dollar. Position sizing matters more than conviction. You could be completely right about a company and still blow up your returns by going too heavy when you should have stayed measured. There's something almost philosophically satisfying about an income stream that doesn't require you to predict the market, outsmart algorithms, or time anything correctly. It just requires you to own good businesses and wait. Patience is the actual edge here, and it's the one edge that's completely free and almost nobody is willing to use. The irony of dividend investing is that it's boring enough that most people won't do it consistently, which means the people who do show up with discipline and process tend to quietly win over long time horizons while everyone else chases the next narrative. We have collectively been handed a strategy that works in part because it's too unsexy to go viral. At the end of the day, whether the market rips higher or corrects sharply in the next 12 months, a well-constructed dividend portfolio keeps paying you either way, and that comfort with uncertainty is not apathy, it's rational preparation built into the architecture of the strategy itself. You're not guessing what the market will do, you're getting paid while you wait for the answer. Discipline, sizing, consistency, those three words are worth more than any hot ticker symbol anyone has ever slid into your inbox. The boring path traveled with patience and without ego, is almost always the one that actually gets you there. And if you're ready to put capital to work, whether that's dividend investing, real estate, or finding the right lender to fund your next move, check out our links in the description below and let's get you started.